to the next point. We should ensure whatever we say is clear.
That means work is being done. We can see that it is in opposite direction.
Hello, my dear students at home. It's good meeting you once more, as usual. My name is Abbas Shehu, your commerce teacher. Today we are going to look at a topic that is known as central bank. Central bank. In our last class, we talked about what is a commercial bank, what are the functions and roles of commercial bank. Today we are going to look at central bank. And under this topic, we intend to look at the following. One, we'll talk about meaning of central bank. 2, historical development of central bank. 3, characteristics of central bank. 4, functions of central bank. 5, how central bank control commercial banks. 6, differences between central bank and commercial banks. 7, bank clearing house and its types. Then 8, we will look at summary. And then finally give you assignment, as we always do. The first one, which is meaning of central bank. Central bank is the highest financial institution giving privileged control over production and distribution of money and credit for a nation or a group of nations. Central bank is an institution that manages the currency and monetary policy of a state or a formal union and oversees their commercial banking system. From what we have just said, central bank is the highest financial institution given the right to produce money and at the same time issue out the money, distribute the money for circulation, for people to have access to the money in order to transact their daily activities or daily businesses. That's what we mean by a central bank. And central bank is usually owned by the government, the federal government of every country. So every country has a central bank, just like we have in Nigeria, Central Bank of Nigeria, abbreviated as CBN. The same thing applies to Ghana. They have Central Bank of Ghana, Central Bank of England, so on and so forth. Having talked about the meaning of central bank, the next thing we are going to look at is historical development of central bank in West Africa, and of course in Nigeria. In West Africa, before independence, there used to be what was known as the West African Currency Board. The West African Currency Board, which was the highest financial institution at that time. And it performed the functions of what the central bank today is performing. That is the issue of producing and distributing currency. At that time, the West African countries were grouped together, and this board was charged with the responsibility of producing money, which they use, and at the same time, distributing the money to them. Now, the goal of the West African Currency Board at that time was to keep the currencies of the West African nations at par with the pound sterling. Now, after independence, different countries set up their central banks to ensure their rapid economic development. Before independence, there was board that was acting as the central bank. After independence, after West African countries started getting their independence, they now started to have their own individual central banks. And the central banks were, at that time, established in those countries of West Africa in order to bring out policies that will lead to their rapid development in terms of their economy, in terms of their macro economy. Like we said, after independence, different countries set up their central banks to ensure their rapid development economically. Now, in 1957, the Central Bank of Nigeria was established. as one of the recommendations of Mr. J.B. Lewis, who was charged with the central bank that was established was charged with managing the currency of the whole nation, of the whole country, which is Nigeria. That is just about a brief historical development of central bank. And of course, central bank in Nigeria, and then of course, central bank in other West African countries. We will look at now characteristics of central bank. We have just discussed meaning of central bank and historical development of central bank in West Africa. We are moving now to the third item, which is characteristics of central bank. What are those features that we talk about when we're talking about central bank? One, it is not profit oriented. Central bank is not like commercial banks. In our last class, we discussed commercial banks, and we discussed them as profit oriented. They are out to make profit, but central bank is not established with the aim of making profit. It is not profit oriented. Number two, there is only one central bank in a country. In each country, there is only one central bank. You don't have two central banks in a country existing in one country. One country, one central bank. Number three, it is the highest financial institution. It is the highest commercial institution that controls all other financial institutions. Number four, it is established by the Act of Parliament. It's established by the Act of Parliament. Number five, it is owned by the government. And to be precise, federal government. Number six, there is no transaction with private individuals. The central bank does not have any transaction with private individuals like the commercial banks, like other banks. The central bank is not dealing with individuals. Central bank deals with banks and other financial institutions, deals with the government. That's talking about the characteristics of central bank. Now we go to functions of central bank. Functions of central bank. There are several functions performed by central bank of every country. Number one, banker to the government. Central bank acts as banker to the government, meaning that the government, we're talking about federal government here when we talk about government. The federal government account is in central bank. It is the central bank that controls the account of the federal government. And when we're talking about control here, we're talking about all receipts of money belonging to the government, belonging to the federal government, is done by the central bank. So also payments that are to be made by the federal government to other governments or government levels or other individuals or other corporate bodies is done by the central bank. And it is also the place where the federal government keeps its money. And that's why it is called the banker to the government. It performs the function of being a banker to the government. Number two, issuance and control of currency. It is the central bank that gives direction for the currency being used in a particular country to be produced. And not only that, to be distributed. To be produced and at the same time distributed. To be printed as well as circulated. It is the central bank that has that right. No any other financial institution is having that right. No any other individual is having that right. Number three, it serves as banker's bank. It serves as banker's bank. All other banks keep their deposits with the central bank. All other banks keep their deposits with the central bank. Just like we keep our money, our other valuables with commercial banks, so also commercial banks and other financial institutions. They are expected to keep their money with the central bank. That's why they perform the function of being banker's bank. Number four, they serve as lender of last resort. Lender of last resort. Just like we go to commercial banks and other financial institutions to borrow money. Other banks too, commercial banks, to go to the central bank to collect loans. And that's why they are referred to as lender of last resort. When commercial banks and other financial institutions are in financial difficulty, they rush to the central bank for assistance. They go there to collect loans. So they serve as lender of last resort. Number 5, foreign exchange transaction. Central Bank of Nigeria is the sole financial institution that regulates the aspect of foreign exchange in terms of other currencies. You want to go, for example, abroad to buy goods, the money you are to get that will be used there is normally obtained through the central bank. It's the central bank that will tell the whole country how much a particular dollar will be sold or bought, how much dollar, how much pound sterling, how much whatever, real, so on and so forth, how much each will be purchased from them, and then of course from other commercial banks. They are the ones that will say that. They provide what you call foreign exchange transaction. They assist by making currencies available so that those going out to engage in international trade can get what they can use by the time they go there. So also those that are coming from other countries to buy from us, what we have here. When they come here, they buy what they want to buy using our own currency. And the currency is normally obtained through the exchange, through the foreign exchange. That's number 5. We now go to number 6. The central bank is responsible for what is known as money or monetary policy. Money or monetary policy. And this is talking about policies made or designed that are to control the flow of currency within a particular country in terms of the volume of money to be made available that will be circulated for people to transact businesses, for people to transact their businesses. By the time we go to how central bank controls commercial banks, we'll talk about more on this. Number 7, central bank formulates rules and regulations guiding banking industry. Since it is the highest financial institution, since it is owned by the government, then it, of course, is discharged with the responsibility of bringing out all rules and regulations that will guide the banking industry, how other banks can operate, how other financial institutions can operate. What are the rules that they must follow in order to operate in terms of their minimum cash ratio, in terms of their minimum deposit with the central bank, in terms of their bank rate charges when giving out loans, so on and so forth. All these are rules that are normally made by the central bank. Other banks, commercial banks, are just there to implement or to follow or obey. Now we have number 8. Let's talk about external business. External business. Whenever a government is going to engage with other countries in terms of monetary issues, it is the central bank that will do that on behalf of the government. For example, let's assume there is going to be loan to be collected from the World Bank by the federal government. or to be collected from IMF, it is the central bank that will do that. It is the central bank that will carry out that. Now, of course, we have the last one, which we say other functions. They carry out other functions like what? Other functions like servicing what is known as national debt. It is the central bank that will be servicing national debt. And when we talk about servicing national debt, we're talking about where a country collects loans from World Bank, from IMF, and other international monetary organizations. They are expected to pay interest on those loans. The interest they normally pay, year in, year out, is what we refer to as servicing of national debt. So it is the central bank that does that on behalf of the government, on behalf of the country. Let's talking about functions of central bank. Now let's go to how central bank controls commercial banks. Control commercial banks. There are several ways that the central bank controls commercial banks. One of the ways is through what is known as open market operation, abbreviated as OMO. Open market operation. And before we start to talk about how the central bank control commercial banks, it's important for us to look at in what way is the control done when we're talking about control here. In control here, we're trying to look at how the central bank controlled other commercial banks in times of either expanding or contracting the volume of currency in circulation. That's what you're talking about. The volume of money, whether to be in large quantity or in a small quantity. There are several reasons why central bank can say, let's have the currency to be in large quantity in circulation, or let's reduce the number of currency in circulation to a particular level because of one economic reason or the other, depending on the situation. In terms of inflation, for example, where we have a situation where there is higher increase in terms of price of goods and services. The price of goods and services keep on going up and up. The federal government can come and say, okay, now what do we need to do in order to cut this problem of inflation? They can say, okay, let's reduce the volume of money in circulation. By reducing the volume of money, we expect to see that goods and services that are there will not be bought. And the moment they are not bought, their prices will go down. So this is what we are talking about when we're talking about how central bank control commercial banks. We're talking about the extent of money in circulation. The volume of money in circulation, is it going to be in large quantity or in small quantity, depending on the situation? So we have the first one we are going to discuss here, which is open market operation, abbreviated as OMO. Now, this is a situation where the central bank will sell or buy what is known as securities, bonds. By buying, the central bank is indirectly reducing the volume of money. By the time they are buying from all angles, buying from commercial banks, securities, buying from individuals, by the time they are buying, they are tactically withdrawing the volume of money in circulation. Where they want to put money into the economy, they buy the securities from people. By buying, of course, they are paying and putting money. And where they want to withdraw money, they will begin to sell these securities to the commercial banks. By the time they are selling, they are getting money and withdrawing the volume of money in circulation. And that's what we mean by open market operation. Then we have number 2, means of control, which is liquidation ratio. Liquidation ratio, or what is known as cash ratio. This is where a particular amount of money that the central bank asks the commercial banks to keep with them. To keep with them as a cash ratio. That you should, this is the total amount of money you are expected to have in your banks. That no matter what, you should not go short of this amount of money. If you are going to give loans to your customers, whatever you're going to give to your customers, let there be a particular amount of money that you are keeping with your bank, that you are keeping in your banks. This is what you call liquidity ratio. It could be a particular amount of money, and that will be given generally to all commercial banks. That if you must operate, you must give out loans, do not run short of so amount of money being kept in your account, in your bank. That's what you mean by liquidity or cash ratio. Then we have bank rate. Now before we go to bank rate, let's look at how this liquidity ratio affects the volume of money in circulation. It affects the volume of money because the higher the amount the central bank is asking the banks to keep as their liquidity ratio, then the lower the amount of cash that will be available within the circulation, and vice versa. Now we go to bank rates. This is talking about the charges being placed on loans given by banks. The charges can be high or low, depending on what is needed. If there is need for the volume of money to be reduced in circulation, then people will, the central bank will ask commercial banks to charge less. If they want to reduce the volume of money in circulation, where they want to reduce the volume of money in circulation, they will now place a very high rate of interest rate so that people will be discouraged from borrowing. And by the time they are discouraged from borrowing, then it means they will have less money with them, and which automatically means that there will be less money in circulation. And where they want to pump money into the economy, where they want a large quantity of money to be there, they will now make the interest rates to be very low so that everybody can rush to the bank and collect loans. So that people rush to the bank and collect loans. And by the time they are making that, they are doing that, money will be available in the country. Money will be circulating. Money will be high in terms of supply in the economy. Then we go to what is known as special directives. Special directives. This is where the central bank gives a kind of special directives to the commercial banks on different matters. They can give them, for example, a special directive to give loans only to specific sectors of the economy. They can say, okay, we are giving you a directive that you should pay more attention to giving loans to farmers in order to boost the agricultural sector. Or we are giving you special directive to give loans to only those that are in industrialists, so that they will boost their industrial sector. This is what we call special directive. Then we have special deposit. Special deposit. This is where the central bank will say, okay, come and keep a particular amount of money with me. Come and keep a particular amount of money with me. Like we said, depending on the situation in the economy. If they like to reduce the volume of money, they now ask the commercial banks to pay high, to keep a high percentage of their total money with them. Where they want to pump in money, they will now ask them to pay less. We call this special deposit. And the last one we have is what is known as moral persuasion. Moral persuasion. It's not everything that you give directive. There are times you need to persuade somebody. Talk to that person, put sense into that person, for the person to be persuaded in terms of doing one thing or the other. This is what you refer to as moral persuasion, depending on the situation. You persuade them, tell them this is what we want you to do in terms of your this or your that will make our economy to be this or that. Just try to persuade them, not try to force anything on them, not try to force them to do anything, but just persuade them. We refer to this as a moral persuasion. And these are the six ways by which the central bank control commercial banks. Okay, because of time factor, we are going to stop here and start from here in our next class. We'll look at differences between central bank and commercial banks. Then we'll also look at clearing houses and then their types in our next class. It's unfortunate that time is not on our side and we cannot give you assignment as usual. But that notwithstanding, keep on reading your books. We hope to see you in our next class. In case you want to ask any question or you want to make any observation or comment, you can reach me as usual through my number, Abbas Shehu, on 081-00-127-508. Stay safe and keep learning. Have a nice time. See you in our next class.